has experience of 14 years in mutual fund industry, and he has been associated with ICICI Prudential AMC for a longest period of time. And over there, he was heading strategy products. So Manuj has also done his masters in finance, and he has been, a CFA charter holder from CFA Institute of USA. So, during today's webinar, Manuj will take us through what actually Whiteoak Group is and what NFOs we are launching. And currently, we are running a NFO, which is Whiteoak Capital Flexicap Fund. So, he will take us through the entire product and its strategy. So, without wasting any more time, I would like to hand over to Manuj to take this webinar forward.
Right. Thank you, Jatin. Jatin, I hope my voice is audible.
Yeah. Yes.
Yeah. Thank you so much for confirming. So, good morning, everyone. What I'll do over the next, let's say, 20 minutes or so, I'll briefly cover what is Whiteoak Group is all about, and the latest offering that we have, which is Whiteoak Capital Flexicap Fund. We'll discuss that also. That what do we offer in this product? Okay. So, starting with our background. So Whiteoak Group, as we know, is now about 5 years old. It was started by Mr. Prashant Khemka. Prashant Khemka is our founder. As we speak right now, we manage roughly around 40,000 crore rupees of equity. And the good part about this assets that we manage is that the entire money is invested into Indian, almost entire money is invested into Indian equity market. This entire money is actively managed. We don't run any passive strategy, and we are an Indian company. Basically, we are Indian MNC. We have offices in India, Singapore, Mauritius, Switzerland, and UK. Out of this 40,000 crore rupees that we are discussing, which is asset under management, about 30,000 crore rupees is basically given to us by foreign investors to invest in India. So we run funds domiciled in Ireland, Mauritius, etc. And we collect money from people sitting outside India. They can be ultra HNIs, family offices, institutions like pension fund, endowment, sovereign wealth fund, etc. They give us money and we invest in India. In India itself, we are already running a couple of products in the AIF space and the PMS space. And within India, we manage roughly around 11,000 rupees of equity via PMS and AIF. And now we are venturing into mutual fund as well, and launching our first equity mutual fund named Whiteoak Capital Flexicap Fund. Little bit about our founder, Mr. Prashant Khemka. So before starting Whiteoak in 2017, for 17 years, he was associated with Goldman Sachs Asset Management Company. And in his last assignment, he was CIO and lead portfolio manager for India Equity Fund and Global Emerging Market Fund. And in fact, his track record was so exceptional that he was rated AAA by CityWire, which is the highest rating any global fund manager can get. And there are only a handful of fund managers who got this AAA rating, and Prashant is one of them. So with that background, and as I mentioned that the 40,000 rupees we manage, roughly around $4 billion is international asset. We brought some $4 billion, 30,000 rupees from outside India investor to India. And you would be glad to know Whiteoak is one of the largest foreign portfolio investor for India over the last 5 years. We have brought in some $4 billion in Indian equity market. In terms of our leadership team for asset management business, Ashish has joined us from Motilal. He's the CEO for Whiteoak. Before that, he was CEO for Motilal Oswal for about 8 years. And before that, he was heading retail sales for ICICI Prudential Asset Management Company. CIO is going to be Mr. Ramesh Mantri. Ramesh is a CFA, CA, and he did his master's MBA from FMS Delhi. He has about 18-19 years of experience. He is founding member for Whiteoak Capital. Prateek is going to be our CBO. The background about Whiteoak is that we don't have any other business but investment management. We don't run any other financial business like bank, insurance, broking, wealth outfit. We don't have any other business, but our core competency is basically into managing asset, be it domestic assets or global emerging market as well. We strongly believe that the important pillars of investing is that you need to have a very seasoned investment professional team in your uh, investment team. You need to have seasoned people who should be good stock picker. Second, you need to have some defined process, a very well defined process to make good return for the investors. And you need to have some philosophy which can be consistently replicated. And there should be a good portfolio construct. If you make a portfolio which can generate good alpha, that is one thing, but you need to make a portfolio which can generate reasonably good alpha on a consistent basis. So let me cover some of this part one by one. As far as people is concerned, at a group level, as I mentioned, we manage PMS, AIF, and we manage offshore money as well. And right now we are venturing into AMC business as well. So if put together at a group level, we have a team of about 35 member investment professional in our investment team. And if you compare our investment team size with most of the asset management company or AIF PMS house in India, you will find that we have a fairly large team compared to some of our peers, and which we believe is important because ultimately for managing money, and if you want to pick pick some good companies, you need a very large team, investment team. You need a very large research analyst team to analyze some of the companies. Like we analyze something like 750 companies. So 750 companies with a market capitalization of more than 1,000 crore rupees approximately, and we zeroed down. I mean, we do our analysis. I'll cover in detail over the subsequent slide, and we left with some 50 to 80 companies which are not only good business but are available at a reasonable valuation. And we, with those 50 to 80 companies, depending on the objective of the funds we are managing, we allocate our money on those 50 to 80 companies. So we believe that philosophy is important, and our philosophy is very simple. We try to buy some great business at a reasonable valuation. The definition of a great business is that it should generate superior return on incremental capital. Basically, it should have decent margin. Second, it should provide a scalable long-term opportunity. Having a decent margin is not enough. The business itself should be long-term scalable. And lastly, if business is generating reasonable margin, second is also long-term scalable. Also, it has to demonstrate superior execution and governance. Basically, we are talking about corporate governance. So we look for these attributes in our definition of a great business. But usually when a business has, or let's say stock has these characteristics, you will not find those stock at a reasonable valuation, and most of the time you'll find that some of these stocks are already overpriced. So we need to figure out that if we find some good businesses which are scalable, provide long-term opportunity, and provide good margin and has a good governance, they should be available at a reasonable valuation. And for that, we try to figure it out whether they are available at a reasonable valuation or not. Second, the whole process. At Whiteoak, we generally what we do, we divide a company, with whatever company we are analyzing, we divide that company into two parts: investing company and, let's say, operating company. Okay, and we try to figure it out that whether the business is using the capital provided by, let's say, the promoter effectively or not, or in short, whether the business is generating excess return on invested capital. So for example, a promoter can invest that money somewhere else and make, let's say, 11-12% as a cost of capital. So if the business is not generating more than that, more than the cost of capital, that means that business model is not sustainable and will not make wealth for the investor. So we try to avoid that. Last point before I jump into our Flexicap fund and how it's going to be managed, etc. Lastly, we believe that investors giving us money is basically they expect us to generate alpha, which is basically excess return over and above the benchmark. And to generate excess return over and above the benchmark, there are basically two ways. As a fund manager, you can make alpha. One is that you take some macro call, and that is called allocation effect. You take some macro call based on those macro call कि crude कहाँ जाएगा, inflation कहाँ जाएगी. Based on those macro call, you decide which sector to be overweight or underweight, or sometimes you take cash call. This is one way to generate alpha, but we strongly believe that taking macro call and taking right macro call consistently is impossible. Sometimes it go right, sometimes go wrong. So if somebody is making alpha for you just because he was very overweight in oil and gas, commodity, metal, etc. before Ukraine and Russia war, or if somebody is making you alpha because 2.5 years back, let's say in January 2020, he or she was overweight on pharma, that means there's a great amount of luck involved. Okay. But if somebody is making you alpha because of superior stock selection, okay, that means there is a matter of skill. So we strongly believe that while alpha can be generated with a combination of allocation effect, which is basically taking macro call, or by superior stock selection, at Whiteoak, we try to focus on stock selection. We don't take macro call. We don't try to figure it out whether crude will be at 150 after 3 months down the line, or it will be at $80 or down the line. We basically focus on stock selection, which we believe is the right way to create a balanced portfolio. What do I mean by balanced portfolio? Let me spend 1 more minute here. So why we believe that taking macro calls right consistently is impossible. I mean, if you take 20 calls broadly, you will go right on a 10 times and you will go wrong at 10 times. Hence, you won't be able to generate consistent alpha. But so while we believe that taking consistent macro call right is impossible, but we do believe that if crude goes to $150 and remain there for some period of time, it will have impact on the portfolio. Likewise, if crude falls to $60, for example, and remain there for some time, it will have impact on the portfolio. So to minimize the impact of extreme macro events, we try to create, and we believe that it is better that as a portfolio manager, we create a balanced portfolio of pro-cyclical and counter-cyclical stocks. Pro-cyclical stocks means those stocks which basically go hand in hand with the economy. If economy is doing good, they will do good, or vice versa. And counter-cyclical, as you know, will be opposite of that. So in short, whatever we have discussed right now on this important pillars of investing is that we believe that we should have, as a fund manager, we should have a very large team. And in fact, at Whiteoak, as I mentioned, at a group level, if we put together all our businesses, we have a very large team of about 35 investment professionals, which is one of the largest. We believe in simple philosophy of buying decent, good stock at reasonable valuation to figure it out whether the valuations are good or not. We believe that if businesses are generating excess return on cost of capital consistently, that is a good way to look at whether business will generate wealth for the investors or not. And lastly, the first three things will help you to generate alpha. The fourth thing, which is the portfolio construction, will help you to bring consistency of the alpha. So if you can make a portfolio which is a balanced portfolio of cyclical and counter-cyclical stocks, which has a combination of large cap, mid cap, small cap, which is a combination of stocks which are sometimes called value stocks or growth stock. So if you diversify this stock in the portfolio in a manner that it consists all large cap, mid cap, small cap, cyclical stocks, non-cyclical stocks, stocks from various sectors, you can not only generate alpha, but generate consistent alpha over the period of time. So with that thought, let me just show you three, four more slides before I jump into the last topic, which is the Flexicap fund. I'll spend 5 minutes more on that, and then we can take some questions if you may have. Also, if you look at this chart, this basically is telling you that in each of the calendar year, which sector did best and which sector did worst. So at the top of the sectors mentioned in the top of the row are the sectors which performed the best in that calendar year. At the bottom of the table, the bottom row basically is telling you the sectors which did worst in that particular calendar year. So you will find that each of the year, okay, almost each of the year, the top performing sector and the bottom performing sector keep on changing, and it is almost impossible, okay, to consistently figure out which sectors will be at the top of the table and which sector will be at the bottom of the table, because to predict this thing, you have to predict macros, that what will be the crude. I mean, 7 months back, nobody could have predicted that crude will jump by $40 in a matter of 2 months, and but reality is that crude was up $40 in a matter of couple of months, and there will be reasons for that. So we don't try to predict At Whiteoak, we don't try to predict which sector will be at the top and the bottom. Secondly, there are various fund management styles. Some fund managers categorize themselves as value buyers, and some categorize themselves as quality buyers or growth buyers or momentum buyers, etc., etc. So taking a very skewed bet. So as a fund manager, if you make a portfolio which comprises of all these stocks which are categorized as value stocks, maybe, I mean, one of the general definition of a value stock is that it will be available at a very low PE or PB, etc., etc. So if you make a portfolio of very low PE, PB stocks and you call yourself quadrillion or value investors, and the portfolio is heavily skewed, tilted towards value stocks, so the journey of that portfolio's performance can be very painful. Sometimes you will be at the top, sometimes you will be at the bottom, and then there can be times for many years, like 2-3 years, you will be at the bottom, and that kind of give very negative experience to the investors. While maybe at the 5 years time the line, there will be 1 year you will generate a lot of alpha, and eventually you will start doing good. But the journey during those 5 years can be very painful. So we at Whiteoak don't believe in taking very skewed calls to a particular style of fund management. We don't categorize ourselves as a value investor or a value quality investor or growth investor. We just try to buy a good company at reasonable valuation, no matter which sector it belongs, no matter you categorize it as a value stock or growth stock or a quality stock. Third thing, again, on a calendar year basis, you look at the performance of, let's say, Sensex, large cap index and mid cap index, you'll find that the market cap winners also keep rotating. Now, this is not something new, but just to make it a point that, again, it is almost impossible to consistently predict which market capitalization will do good in this subsequent year. Only in the hindsight we will know that obviously mid cap has to perform well. Only in the hindsight we will know. So we don't try to predict that also. Last slide, or I can say second last slide, that on this slide you'll find that these are sectoral breakup for 3 of the index. One is, let's say, large cap index, Nifty 100. Second is mid cap index, Nifty mid cap 150, and third is small cap index. So there are many businesses you'll find which are only available in small and mid cap segment. Like the largest textile company is not a large cap company. The largest media company is not a large cap company. The largest chemical company, I think, is not a media company. So there are many niche businesses you will find only in small and mid cap segment. And small and mid cap, by virtue of the fact that there are too many small and mid cap, like there are about 100 large cap company, 150 mid cap company by the definition of SEBI, and all rest of the companies listed on stock exchange are categorized, let's say, as a small cap company. So mid and small cap to be specific, by virtue of definition, has a very large tail, is more diversified, has niche businesses, and hence they are less researched. Because to research so many companies, let's say, as I mentioned, companies with more than 1,000 rupees of market capitalization, there are about 750 companies approximately. It keeps on changing because of mark to market. So to research all those companies, you need a very large team, which is not the case with most of the fund houses. And hence, if you have the capabilities in-house, if you have a very large team who can do analysis and figure out which are those companies in the small and mid cap segment which are very cheaply valued, you can generate a lot of alpha. So to sum up whatever we have discussed that sector leadership keep on changing, and it is almost impossible to consistently figure out which are the sectors which are going to be at the top. Secondly, taking very skewed calls toward or categorizing yourself as a value investor or a growth investor may result in a very painful journey over the next 5 years, or for the matter of fact, any 5 years. While you can generate decent alpha over the 5 years, but the journey of that 5 years will be very painful, because sectoral leadership keep on changing, and a particular style of fund management will work in certain year, will not work in the certain year. Thirdly, small and mid cap leadership keep on changing, small and large cap, mid cap leadership keep on changing, and small cap and mid cap segment has a very large tail. It provides you a lot of niche businesses and less research. So if you have a very large team who can do analysis and figure out which are the stocks in this mid and small cap space which are good businesses and available at a reasonable valuation, so you can generate a lot of alpha. So with that background, we are launching our first equity fund on the mutual fund space named Whiteoak Capital Flexicap Fund. The NFO is open from 12th to 26th of July. It is an open-ended fund. You can enter and exit any point of time. This product has only 1 month's exit low. So if you invest today and if you want to redeem anytime after 1 month, there is no exit load you need to pay. So what we are going to do in a FlexiCap fund, as you know, SEBI has categorized various mutual fund categories. Like in large cap category, as a mandate, if you are running a large cap fund, as a fund manager, you have to invest minimum 80 to 100% in large cap stocks. Large cap by definition is that the top 100 stock in terms of market capitalization are called large cap stock. So if you are running a large cap fund, you have to invest 80 to 100% of your money of the portfolio in large cap stock. If you're running a mid cap fund, you have to invest 65 to 100% into mid cap. A small cap fund manager has to invest about 65 to 100% in small cap fund. In multi cap, if you are running a multi-cap fund, you have to invest minimum 25% into large cap, minimum 25% in mid cap, minimum 25% in small cap. But if you are running a flexi cap fund, that gives you a lot of flexibility. Okay, so as a flexi cap fund manager, you can invest 0 to 100% to large cap, 0 to 100% to mid cap, 0 to 100% into small cap. So there is no restriction that you have to at all point of time invest minimum 25% into small cap, or let's say minimum 80% to large cap, and hence this category is more suitable to any active fund manager who don't want any restriction that okay, I'm going to invest in equity, but don't put any restrictions on me that minimum 50% or minimum 65% has to be in mid cap, etc. And that suits us as a fund house. So what we are going to do, last couple of slides before I open the floor for Q&A. We have a very large universe. So we analyze some 750 company approximately. The number keeps on changing because of the market cap change, but approximately 750 companies, which is a market cap of more than 1,000 crore rupees. We do an analysis to figure out that whether these companies are good businesses and available at a reasonable valuation. So when we do our first filtration of figuring out whether we call it a good business or not, we left with about 250 odd companies. And out of that 250 companies, we do an analysis to figuring out that whether these companies are available at a reasonable valuation or not. So we left with only 50 to 80 companies approximately at various point of time. And with those 50 to 80 companies, we create a portfolio. Those companies will be obviously from various sectors and from various market capitalization that we don't decide at the beginning, but it is an outcome of which kind of companies we are finding at attractive valuation. They can be from various sectors and they can be from various market cap. So to sum up, what we are going to do in our FlexiCap fund, Whiteoak Capital FlexiCap fund, there is no market cap biases, and we can invest in any company from large cap, mid cap, small cap. We will maintain a sectoral balance, which means it is going to be a diversified fund, which will have, let's say, banking, IT, consumer discretionary, etc., all kind of sector, pharma, etc. So it will be a diversified portfolio, and we as a fund house don't have any style biases. We don't categorize ourselves as a value buyer that we will only buy low P stock, or we don't categorize ourselves as a quality growth buyer that we will only buy companies which are growing rapidly even if they are available at 100 P. We don't do this, all those things. We maintain a diversified portfolio across sectors, across market capitalization, and across style. Basically, we need to be a bottom-up stock picker. Whatever companies we like, we buy those companies. We don't, I mean, intuitively we don't see whether people call it as a value stock or a growth stock. So with that, let me take a pause here, and if any one of you has any question, I would be more than happy to discuss. So yeah, Jatin, over to you.
Yeah, thanks Manuj for such a wonderful presentation and insight on markets and product. So I'll request investors to put up their questions on the question box so we can answer it. So before anybody puts up the questions, Manoj, I have few questions from my end. So why
Yeah.
would a person go for Whiteoak Flexicap fund when there are other Flexicap funds available in the market? So what differentiates Whiteoak from the other Flexicap fund?
Yeah, thank you so much for asking this question. So there are a couple of differences. One is that uh, what I have noticed is that many of the flexi cap funds, I'm using the word many, I mean, there can be exceptions, but many of the flexi cap funds are basically investing anything like 75 to sometimes 85 also, but let's say 75 to 80% into large cap and remaining, let's say 20-25% into small and mid cap put together. Which is fair also because if you look at the benchmark, which is BSC 500, BSC 500 has something like 22% small and mid cap. So if you are locating, let's say 25% as a fund manager into small and mid cap, so it is to some extent fair also. But as a fund house, we strongly believe, like we discussed, that there are many opportunities, there are many niche businesses you can find in small and mid cap space. So what you can expect from Whiteoak Capital FlexiCap Fund, that you can expect under normal circumstances, we will almost always be overweight in small and mid cap. So you can expect like 35 to 40% allocation roughly. This is a tentative number, but let's say 35 to 40% allocation in small and mid cap. So that clearly differentiate us from some of the other flexi cap fund, which are basically very heavily tilted towards large cap. There is nothing wrong about it, but we believe that if you have a very large team of investment analysts, and if you can do bottom up stock analysis and pick some good stocks from small and mid cap space, the alpha generation potential in small and mid cap is far superior as compared to large cap, because of the simple fact that there are many analysts tracking small cap very closely, and you tend to find less opportunity to generate massive alpha in small and mid, in large cap space. So this is one thing. Secondly, like I mentioned, that many existing fund house categorize themselves, or fund managers categorize themselves as a value buyer or growth buyer, quality buyer or momentum buyer. Now this biasness gives you very sometimes very painful journey of couple of years of massive underperformance, and then third year of massive outperformance, and hence everything even out. But for those 2-3 years when funds is not performing consistently for 3 years, it become very challenging for the investors to stay invested. What we are doing is that we are not binding as a style of fund manager. We don't categorize ourselves as a value buyer or growth buyer, and we maintain a healthy balance of all the sectors and all the market capitalization and all the style of fund management when it comes to stock picking. So that these two things, the fact that we are bottom of stock picker, we don't care whether the stock belongs to large cap, mid cap, small cap, value, growth, which sector it belongs, and the fact that we are always be slightly more overweight on small and mid cap under normal circumstances as compared to BSC 500. Yeah, Jatin.
Yeah, thanks. So I have few questions. One is from Deepak Lula. What are the management fees and how does one track your performance?
Yeah, yeah. So SEBI has this capping on management fees. So जो normal SEBI की capping होती है, which is that जैसे जैसे AUM बढ़ता जाएगा, आपका expense कम होता जाएगा, वही जो भी SEBI का regulations है for mutual fund, we follow those regulation. And अब जो management fees है, it is a function of how much AUM we would be able to gather. तो अभी वो जैसे स्लैब्स होते हैं, फॉर एग्जांपल फॉर फर्स्ट 250 crore rupees or something you charge 2.5%, but if your AUM goes up by let's say 1000 crore rupees or 2000 crore rupees, the overall average management fees will keep on dropping to certain extent, and it will be less, let's say at one point of time less than 2%, or at some point of time it will be. So it all depends how much AUM we will be able to gather during the NFO and in subsequent years also. So as our AUM will keep on going up, the management fees will keep on coming down. So there is a SEBI formula which is readily available on the public platform. You just need to Google it out and you'll find all the slabs. Yeah, what was the second question, Jatin? Sorry, I missed out.
How do they track our performance?
Performance, yeah. So NAV, the NAV will be available on a daily basis on MFI website and in various third-party platforms also. It will be readily available. So it is very easy to track our performance on a daily basis. So on a daily basis, we give you a report that the 100 rupees you have invested, what is the current value on a daily basis. So very easy to track our performance and even to compare our performance with the existing products in the market. So it is very easy in mutual fund space.
Another question is, what kind of return a person should or an investor should expect from this kind of fund?
Sure. So let me show you one slide. Just a moment. So you see this chart. Okay, this is basically the last 30-year data, and you will find the this line, the basically the third line is basically telling you uh, Sensex EPS growth or the earning growth, or basically the profitability growth of the Sensex company. The middle line is telling you the nominal GDP growth of our country. Nominal GDP growth is, as you know, is basically real GDP growth plus inflation, and the top line is basically telling you what was the Sensex return during this 30 years or 29 years of period. So you'll find that over the last 30 years, our nominal GDP has grown by about 12.4% on a compounded annualized basis. And the profitability of Sensex company during this period was roughly around same 12% or something on a compounded annualized basis. Because basically Sensex is representing the country's productivity only. The Sensex company is basically representation of our uh, uh, productivity activity in the country. So nominal GDP, which is a combination of real GDP and inflation, has grown by about 12%. The profitability of Sensex has grown by 12% approximately, and hence the return Sensex has generated over this period is also about 12%. And you add, let's say, 1% dividend yield, 1.25% dividend yield, so it will come out to be, let's say, 13% approximately. So over the period of time, the fair expectation from equity market, what this chart is telling you, will be what kind of nominal GDP growth you are expecting. Okay, so let's take some ballpark figure, and you can have your own assumptions, and based on those assumptions, you can figure it out what kind of return you should expect. But let's say you are expecting over the next 5-10 years the real GDP growth will be 6 to 7%. You can be conservative and say it will be 6%. You can be very aggressive and say it will be 8%. Let's say 6%. And you believe that over the next 10 years, the inflation is going to be on an average 4 to 6%. Why this number? That even RBI, which is the central bank, is targeting, let's say, 4% inflation with a band of plus minus 2%. So let's say 4 to 6%. Let's say 5% on an average. So a 6% nominal real GDP growth at a 5% inflation, that leads to a nominal GDP growth of about 11%. So if you have this basic assumption of 11% nominal GDP growth over the next 10 years, so broadly the profitability of Sensex Nifty company will also grow in the similar fashion, and hence the return expectation from broader market should be on the similar line, or let's say 11% in our example. And from active fund managers like us, you would expect that if market is delivering 11% return, you should deliver slightly higher return, maybe 3-4% higher return. And that is what we aim for. That is what we endeavor to generate, that we should beat the benchmark, which is, let's say, Sensex Nifty, or in our case it will be PSC 500, by a reasonable margin. That is what we aim for. So yeah, that should be your expectation.
Okay. Another question is from the investor who is asking who is behind this mutual fund. So
Who is? Sorry?
behind this mutual fund.
Behind.
So
So, okay.
about Whiteoak Group.
Yeah, sure. So basically, I think in the initial phase, I just mentioned that Whiteoak Group, okay, it was founded by Mr. Prashant Khemka 5 years back. So we have 5 years of history now. We manage about 40,000 crore rupees of equity, and this entire money is actively managed, and almost entire money is invested into Indian equity market. We have offices in India, Singapore, Mauritius, Switzerland, UK. We have funds domiciled in Ireland, Mauritius. We collect money from outside India also and invest in India. Out of this 40,000 crore rupees, 30,000 crore rupees, which is like about $4 billion, is basically foreign investors money. Those investors had given us money to invest in India. And about Prashant Kinka, before starting Whiteoak in 2017, for 17 years, he was associated with Goldman Sachs Asset Management Company, and he was heading there as a CIO. He was also lead portfolio manager for India-oriented business and a global emerging market business. So yeah, so as to answer your question very specifically, Prashant Kinka is our founder, and this firm is 5 years old in terms of managing asset in various platforms like PMS AIF. In India, we run PMS AIF very successfully, and I think we are now almost fifth largest PMS AIF house in India within 5 years of our operation.
Okay. Also, if you can highlight on a stock selection process, because I got a few questions on that as well.
Yeah, so basically, first of all, we don't try to time the market. Okay, this is a fully invested equity fund. Secondly, we don't take calls based on macros. Okay, so अपना बहुत simple philosophy है. We try to buy some great business at reasonable valuation. The definition of a great business is that it should generate superior return on incremental capital, which means, let's say, it should bare minimum generate cost of capital. So today cost of capital is roughly 11.5% for most of the business on an average. So if a business is not even generating that kind of return, that means eventually it will not generate well. So it should generate superior return on incremental capital. That business should be scalable. It should have a long-term scalable opportunity available. Thirdly, it should deliver strong execution and governance. So अगर एक business में margin अच्छा है, long-term scalable भी है, but promoter is not working in the interest of the minority shareholders, you will not make money as an investor. तो ये तीन चीजें हमें बहुत इंपॉर्टेंट है, जिसके ऊपर हम अपना एनालिसिस करते हैं. फिर ऐसे बिजनेस यूजुअली सस्ते नहीं मिलते. So lastly है that the intrinsic value or the fair value or the fundamental value of the stock should be higher than the current value of the stock available in the market. And to analyze that thing, we at a group level, we are basically following a certain method from last so many years, and that has delivered very successful result to most of our strategies that we are running. That we divide company hypothetically into two parts. One we call financing company and one we call operating company. So what we assume is that the promoter is dumping all its assets in a hypothetical company called financing company, and the operating company is using those assets. Basically, the company is using those assets to generate revenue, and whatever revenue, or let's say operating profit, that company is generating by using those assets, this company will first pay the rent and lease and financing cost, basically cost of capital, back to the investing company. Okay, and whatever is left, so operating company is using the assets, capital provided by promoter. With those assets or capital, it is generating some cash flow. Now it is paying cost of capital back to the financing company for using those assets and paying taxes to the government. Whatever is left, we call it asset light cash flow or excess return on invested capital. This is basically the cash flow which is in true sense available to the minority shareholder, the shareholders, basically after paying cost of capital. So this method of selecting stocks has helped us over the last 5 years at Whiteoak, and we believe this is one of the good way to figure it out whether the company is doing good or
not. One last question. How is it different from our PMS strategy? How this fund differentiates from PMS strategy?
Okay, so in PMS, okay, so this is a good question. In PMS, you see there are investors who need to invest minimum 50 lakh rupees, whereas in mutual fund you can invest 500 rupees also. So when we manage PMS, the similar kind of strategy, we are aware of the fact that investors who are investing in this fund, in PMS, this is a basic assumption that they are very savvy investors, and they have a slightly higher risk appetite. So in PMS, we take a very meaningful deviation from the benchmark. So a couple of sectors, let's say energy utility, we may go zero also, which has 15% allocation in benchmark. So energy utility put together will have 15% weightage in BSE 500 approximately. In PMS, if we don't find very high good opportunity, we may go zero also. But in mutual fund, because many small retail investors also investing with us along with some HNIs, and they can be savvy or they can may not be very savvy about the investment, equity, etc. So we are slightly conservative. So under similar strategy, let's say on the PMS platform versus on the mutual fund platform strategy will have more diversification. It will have more number of stock. It will have more number of sectoral representation, and hence relative volatility will be slightly less under mutual fund platform. There will be more diversification and hence less volatility in the portfolio. PMS on the other side will have a very meaningful uh, deviation from the benchmark, both in terms of stocks as well as in terms of sectors, and hence will have slightly more volatility. And hence, if we do justice to our stock selection process, we may end up generating slightly more alpha in PMS strategy, but with more volatility. So this is the basic difference.
So no, that's it. Also, I would like to highlight all the audience that it's basically a mutual fund scheme wherein you can get all the details like NAV, performance, portfolio, everything will be available on Whiteoak mutual fund website also, and with HDFC securities also. So with this, I think there are no more questions, and yeah, thanks Manoj for giving us your precious time early morning, and thanks to HDFC Securities for giving us this opportunity to present to their investors. So yeah, with this I would like to end the webinar. Thanks
Yeah,
everyone for joining in.
yeah, same. Thank you so much.